with Mihr Thakar. He's a market analyst joining me from Mombasa in Kenya. Mihr, welcome to the News Hour. Now, this final election result last month was incredibly close. William Ruto getting 50.5%, Raila Odinga 48.8%. Now we've got the final ruling from the Supreme Court on the validity of that result. What do you see a William Ruto presidency actually looking like once he's able to get down to work?
Well, we are certainly seeing a more hands-on approach is about to come. President Kenyatta preferred to rule from his office in terms of, outsourcing and, not particularly using a hands-on approach on the various government departments, but rather, relying on his trusted lieutenants to do the same, which produced a good result, a satisfactory result. But perhaps, there's a bit more level of management skill that should be applied at this point in time.
Well, how have the markets reacted to the Supreme Court's ruling today?
Well, we actually saw Kenya's Eurobond yields fall by about 100 BPS. And in fact, the stock market was up with various stocks, rising on higher volumes than usual. We saw the national utility, Kenya Power, rising about 8% towards market close. So government-controlled companies actually experienced some form of optimism in terms of buying and selling at the market. Although we did see the Kenya shilling was flat, which perhaps reflects more of the fundamental issues. So the Kenya shilling does seem to be continually under pressure. It's now at 120.30, up from about 100. Down from about 100 before COVID-19 struck. And I'm using the USD cashes rate here.
And Mihr, one of the issues that Kenyans in general are going to be looking at is rising inflation, the rising cost of living that really is being experienced in so many parts of the world. How is William Ruto looking at tackling some of those economic issues?
Well, the key tenet of his bottom-up economics is about empowering people at the bottom of the pyramid to expand and increase the impact of their businesses on the general economy. So in terms specifically to cost of living, probably more intervention for farmers. This can range from revitalizing dams within particularly agricultural sensitive areas, all the way to fertilizer subsidies and ensuring that some level of taxes are reduced on imports that are inputs to the agricultural sector. But this can also be a longer-term approach, which could involve, directing more credit to the sector, especially when the sector is deemed high risk and perhaps quite neglected by the banks as at now.
Mihr Thakar, good to speak to you and get your take on this live to us there from Mombasa.